What if I told you that for every 100 American households you know, only about 2 or 3 actually have $1 million saved specifically for retirement? Not net worth, not home equity, not business value, just liquid retirement money. That single statistic alone already knocks down the fantasy a lot of people have been quietly carrying in their head for decades. The idea that one day, when I retire, I'll probably have around $1 million saved anyway. Everybody eventually gets there. No, they don't. Federal Reserve data says the median retirement savings for all American households is around $87,000. Half have less than that. Even among people ages 55 to 64, the ones closest to retirement, the median is only around $185,000. That means the typical person in their late 50s has roughly enough retirement savings to last maybe 2 to 4 years if they needed to fully live off it. That's not comfort. That's not freedom. That's not the retire on the beach fantasy people scroll past on Instagram. Now, when people hear millionaire, they immediately picture luxury. A big house, a nice car, vacations, steak dinners, golf courses, the whole thing. And sure, in some cases, those people exist, but those people are actually not the majority of millionaires. Most millionaires, according to studies like those from Fidelity and Schwab, are just normal people who saved consistently, invested regularly, stayed employed, avoided massive lifestyle inflation, and didn't constantly upgrade their lifestyle every time they got a raise. The shocking part is that most people who do end up with $1 million of net worth didn't earn their way to it through huge salaries. Most simply stayed invested long enough for compound growth to do the heavy lifting. But here's the twist a lot of people forget. Most millionaires are not retirement account millionaires. Huge difference. Someone might have a house worth $500K, a business worth $200K, 2 cars worth $70K total, and maybe $250K in investments. On paper, boom, $1 million net worth. But if that same person wants to retire tomorrow, that paper wealth doesn't magically pay for groceries. Your house does not send you a monthly paycheck unless you sell it or borrow against it. And when you're retired, borrowing against your home means adding debt when you're already out of the workforce. Not ideal. So why does this misunderstanding happen? Because society has mixed up 2 completely different concepts. Net worth rich versus retirement ready. One sounds good. The other actually feeds you. One is I have wealth on paper. The other is I don't need a paycheck because my money pays me. 2 totally different realities. Now let's zoom out. Most people don't get to $1 million in retirement savings simply because they never consistently contributed and because they never stayed invested long enough. The math is honestly on your side if you start early. For example, a simple Roth IRA at average long-term S&P 500 returns can get someone starting in their 20s or early 30s to $1 million by retirement, even with moderate contributions. But most people only realize this in their 40s or 50s, when the clock is already much tighter. Here's something else people underestimate. Lifestyle inflation destroys more millionaire futures than low salaries ever do. When someone gets a raise, what do they usually do with it? They improve their lifestyle. Nicer car, bigger apartment, more takeout food, better vacations, better gadgets. It feels normal. Everyone around them does the same. But slowly, silently, what could have become investable wealth gets eaten alive. And here's the problem. Every dollar you spend today isn't just the dollar itself. It's the years of growth you threw away. That $100 dinner you forgot about by the next morning? It might have been $300 in future value. That $25K car upgrade? That might have been $75K in future value after compounding. Small financial treats become giant financial roadblocks later. Now, let's talk about why even crossing 1 million isn't the finish line many people think it is. People love to joke online, $1 million today is nothing. Usually the people saying that have never actually had it. Is it nothing? Of course not. But is it private jet lifestyle money? Not in 2025. Let's do the real world math. If you have $1 million in a diversified equity portfolio and follow a 4% to 5% safe withdrawal range, you're looking at about $40K to $50K a year in income. Add Social Security, let's say around $24K per person, and now a retired couple is looking at somewhere around $88K to $98K per year. Is that Upper East Side luxury? No. But is that stable middle-class comfort in many parts of the country? Absolutely. And that's the part almost no one tells you. 1 million is becoming the baseline for a decent retirement, not the mark of wealth. Now, let's compare the performance of a liquid $1 million portfolio versus a $1 million home. Historically speaking, equities, stocks, have shown around 7%, 10% annual returns over long periods. That means the growth curve goes like this. Year 0 equals 1 million. Year 7, 2 million. Year 14, approximately 4 million. All without putting in additional money. That's the raw power of compounding. Now let's check real estate appreciation. The average long-term appreciation of US home prices, adjusted for inflation, hovers somewhere near roughly 4% per year. So that same $1 million home might only go to about $1.3 million in 7 years. Still good. Still wealth. But nowhere near the explosive compounding of equities. So one person with $1 million in home equity and $100K in retirement savings may brag that they're a millionaire. But the person with only $200,000 in home equity and $900,000 invested in the market is closer to actual retirement freedom. Same total number, different life outcome. And that's the silent financial divide in America today. The majority of American wealth is trapped inside homes, not inside portfolios, which means people feel richer than they actually are. Because the thing that makes people feel financially safe, their house, is not the same thing that makes them financially free, their investments that pay income. Now let's examine another reason people never reach the $1 million retirement savings milestone. People spend to look successful instead of actually becoming successful. This is one of the most under-discussed traps in modern American life, because social comparison has gone digital. In the 1980s, if your neighbor bought a new car, only like 12 families on your street saw it. Today, people compare themselves to thousands of strangers in seconds on their phone. Comparison is no longer local. It's national and global and constant. So people buy symbols of wealth long before they've built the foundation for wealth. They trade tomorrow's financial stability for today's social approval. That's why so many Americans feel like they're constantly behind. They're not actually behind financially, they're only behind compared to what they think everybody else has. And that's the worst scoreboard to play against. Now, let's pause here and summarize part of what you've heard so far. 1 million saved for retirement is rare. Most Americans don't come close. Most millionaires are net worth rich, not retirement ready. Compounding rewards those who start early. Lifestyle inflation is the quiet enemy. Home equity doesn't pay your bills. Income-producing investments do. We're going to continue this in part 2. Because part 2 is where we answer the question that matters most. If 1 million is the new baseline, how does someone realistically get there, especially if they're starting later or didn't save aggressively in their 20s and 30s? We'll talk about realistic contribution strategies. We'll break down how compound growth actually does the heavy lifting. We'll talk about how starting with small numbers still works. And we'll close with the mindset shift that separates those who retire comfortably from those who just hope they'll be okay. So here's the question every viewer secretly wants answered right now. If only 2 or 3 out of 100 people actually reach $1 million in retirement savings, what separates them from everyone else? Because clearly it's not lottery wins. It's not some secret investment nobody else knows about. And it's not income alone. There are plenty of high-income people who still retire broke. The real separator is consistency plus time. And yes, I know, that sounds too boring to be the truth. But that is the truth. Someone contributing $500 per month to a retirement account over 35 years at a reasonable 7% annual return could hit around $900,000. And that's not counting employer matches, occasional boosts, or raises. That's according to estimates based on historical S&P 500 returns. And someone who contributes more, say $1,000 a month, can get well past that baseline. The part most people never understood in their 20s or early 30s is that the majority of that future balance doesn't come from what they contributed. It comes from growth. The investment does the lifting, not you. The money multiplies faster than you can. And that's why the people who start early, even if they're not high earners, often end up financially stronger than those who start late with higher incomes. Now, here's something uncomfortable but important. Most people don't fail to reach $1 million because they're lazy. Most people fail because they underestimate how much time is required. They assume they'll start later, and then 15 years pass in what feels like a blink. Life gets filled with real-world interruptions. Marriage, moving, kids, medical bills, layoffs, starting a business, car troubles, you name it. Suddenly, they're 50, and the math becomes brutal because compounding needs space, and at that age, the runway is shorter. That's why the ones who end up retirement ready are the ones who treat saving not as something optional, but automatic. They don't wait for leftover money. They treat contributions like a bill. Just like rent, just like utilities. It gets paid no matter what. There's another rarely mentioned factor. People's emotions sabotage them. They panic sell during market dips. They stop contributing when the market falls. They wait for things to stabilize. They spend the money instead of investing it. They chase the next hot stock instead of staying consistent. Meanwhile, the boring people, the ones who quietly dollar-cost average into index funds month after month, they're the ones who end up winning. It's funny how real wealth is built. It doesn't feel dramatic. It doesn't feel risky. It feels slow for a long time, and then suddenly fast. Because compounding doesn't reward you instantly. It rewards you later, violently. And that's where the million becomes more than just a number. It becomes a turning point. Once someone's investable assets cross around $1 million, the portfolio begins doing more work than the person. Their money earns more than their labor. That's when the game changes. That's the moment when someone can stop saying, "I need to earn more," and start saying, "My money is earning for me." Now, let's talk about mindset. The average American thinks of $1 million emotionally, like a symbol. The retirement-ready American thinks of $1 million mathematically, like a machine. Because that's what a liquid portfolio is, a machine that throws off income. And when someone understands that the goal is income, not image, their decisions pivot automatically. They don't buy the latest car just to feel successful. They don't move into a bigger house just because they got a raise. They don't try to impress other people. They quietly make choices that keep their savings rate high. Because millionaire status is not built by what you earn, it's built by what you keep. Now, people always ask, what if I'm starting late? Do I still have a shot? The answer is yes, but the strategy has to shift. If someone is 45, they don't have 35 years to let compound growth snowball. But they might still have 20 or 25, which is still long enough for compounding to work. It just requires higher contributions or more aggressive saving priorities. Maybe that means maxing out a 401k. Maybe that means cutting expenses that don't genuinely raise quality of life. Maybe it means shifting from collecting things to collecting investments. But the bigger shift is internal. The moment someone stops thinking of retirement savings as money they're sacrificing and starts thinking of it as future freedom, everything changes. Because here's the truth. $1 million in retirement savings is not about wealth. It's about independence. It's about not relying on your adult children. It's about not working until your health collapses. It's about sleeping peacefully at night, knowing your bills are covered. Retirement is not a vacation. It's replacing your paycheck. And the portfolio is your replacement paycheck. That's why this topic matters. Because the definition of rich has changed. In the 1960s, $1 million meant you were wealthy. Today, it means you're prepared. One generation saw $1 million as an end goal. Today's generation needs to see it as a starting line for comfort. And here's the twist almost no one talks about. Someone with $900,000 invested and a modest home has more freedom than someone with a paid-off $1.2 million home and almost no liquid investments. Because houses don't pay you. People don't retire on square footage. They retire on income. So here's the final takeaway. And if you remember nothing else, remember this. Net worth tells you how wealthy you look. Liquid investments tell you how free you get to be. And for most Americans, that silent difference determines whether retirement feels peaceful or stressful. So don't measure your progress by what looks good on paper. Measure it by how much of your money is actually working for you. The future doesn't reward the most dramatic lifestyle. The future rewards the most consistent saver. Start early if you can. Start now if you didn't. And treat every contribution like a seed, because compounding is the one farmer that never sleeps. That's how those rare 2 or 3 out of 100 households end up with $1 million saved for retirement. Not because they won the game, but because they actually played it.